All right, we are back with Gareth Soloway, Chief Market Strategist of In the Money Stocks, and the man who's been calling Bitcoin to 20,000 since the end of 2021. We've all been looking for a little bit of a repricing and deleveraging, and you've been holding strong with that $20,000 call. So I think we're getting closer by the day. What do you say, Gareth? Good to have you.
Thanks for having me. It's so good to be back and chat with you. Yeah, so it certainly seems like we're getting there, right? We just breached 30,000 for the first time since 2021. And again, we are getting a bounce here because it is a technical level. In fact, might as well get my charts up so we can kind of take a look. But you can see here very clearly that this level here is where we finally saw that support, which makes a lot of sense, right? And if we just go back and kind of rehash what we talked about, I think a month and a half ago, we were talking about how Bitcoin was in a bear flag pattern formation, right? So you had the high from 69,000 down to the 33,000. And then again, notice how all these highs align, all the lows align, staying nicely consolidating inside of that. And that is, again, a bear flag or in spirit of bear flag. Basically, what I mean by that is if you were to look at this pattern on 1,000 charts, approximately 80% or so would be breaking down. That's what happens to them. So again, when we're looking at technicals, remember that it's all about probabilities, right? So we just try to look for things that happen more than they don't happen, and then we go with that direction. The more, obviously, the higher the probability, the better. But you can see right here, we are at support right now, and we're getting a little bit of a bounce back to 31.6 after we breached 30,000.
Yeah, and I know you and I have had several discussions. It's funny, I hadn't talked to you in probably about a month, and it seems like, things are boring. And then whenever you and I schedule something, we get these huge events. It's really funny. But the discussion is, and my thesis has been, it's going to be very difficult to break that $29,000 level just because over the last, 2 years, there's been so much support there. And that's where a lot of the institutions are really, really jump in and want to start accumulating. But we'll have to see. We didn't break that low yet. That 28.5, I think, was the low of July last year. So right now that still is holding up.
Yeah. So, and one thing, I mean, so in general, what I've learned is that levels that we think shouldn't break, they ultimately do, just because it's the psychological nature. It's like, if you tell everyone to buy at a level, well, inevitably that level will get flushed through because everyone's betting on that horse, essentially. So that has me a little bit concerned about this 28.5, 29, 30,000 level. I do think that we might have made a short-term low with this Terra Luna UST kind of craziness in Bitcoin. So I did go long yesterday and accumulated a little bit over the last 24, 36 hours on Bitcoin just for a trade. So just looking for a bounce. I do think there's a small chance we could get all the way back to maybe 38,000, which would be a retrace to the line that we broke down from. That's kind of called the retrace to the scene of the crime play. But the one thing I would love to share with you is take a look at this. And this doesn't look pretty, but this is kind of so 20,000 is my best case, right? For me, it's like, I can't see it not going to 20,000. I think there's probably an 80% chance that it goes to 20,000 for me. There's also another angle that I'm looking at, which has a price target of 12,000. And I just love to go through this with you. And you can give me your, Greg, you can kind of give me your thoughts on it. But basically, one of the things that I've recognized here is that if you take the high here at 69,000 to the low here of 33,000, that's a $36,000 drop. If you take the high here, 48,000, and you drop that same amount, 36,000, you get a price target of 12,000. So in technical analysis, we refer to that as a measured move, right? So this move here is equal to what this move ultimately could be, right? So the idea there is a potential for a measured move gives us $12,000 as a price target. The only reason why I think that has some credence to it is if you think about previous bear markets for Bitcoin, how much does it drop? It drops 80 to 85%. Well, if you calculate 80 to 85% from 69,000, it gives you right around 12,000. So just my 2 cents, my little debut of the day for you there, Greg.
Well, that's pretty cool. There's one more point of confluence on that number too in a second. But okay, so with a bear flag, you're measuring the flagpole for that leg down. Now, oftentimes it's measured vertically, right, from the peak straight down to the bottom of that 33. What would that be?
So straight down to the 33. So you'd have 69 to, are you talking from the high here?
Yeah, straight down to 33.
To 33. So it's
now,
right to
now
that low.
Measured move, what's the target down with that measured move?
So yeah, we'd have to, I mean, it still should be 36,000. So 69 to
Well,
30,
yeah,
36. So then you would essentially take that same level and then drop it down, but it should be right in that range. Yeah. So I
yeah.
mean, it's kind of interesting stuff. I mean, just playing with the charts. And by the way, for everyone watching this, it's one of the best learning tools in the world is to just play around with things, see what happens. You'll be amazed at how things kind of align when you kind of look at stuff.
Yeah, it's pretty interesting, and then on the thesis of 29,000, lots of support, institutions jump in, they've all got that as their target, but they're also they're not stupid, right? So they know that, well, wait a minute, if we don't buy at that level, it'll drop and we can get a much lower entry and kind of play the game. That was the other thing that I was going to show you right there in terms of the third level of confluence.
I thought that's what you might be talking about. Yeah.
Yeah, and go ahead and what is your point on that?
So I mean, it just for sure is a major support level, right? So you had the high in 2017, and then you had a move up here, and then you pulled back down here, and then you moved up here again. So anytime you hit on a certain area multiple times, it tells you that there's resistance there. Finally, we broke out above it. But a retrace to that, there's no doubt that would be a technical level as well. So you could technically say, okay, you have the 80 to 85% correction, you have the measured move, and you have that major support. Now, again, I think it's important, and I think you'd agree with this, Greg, is that, by no means am I someone who's going to say, all right, I am only going to buy Bitcoin if it gets to 12,000, because what if it goes to 12.5 or 13? So basically for me, I'm looking at my longer term accumulation zone probably being just above 20, all the way down to probably 10, meaning that it could go lower than 12 too. I don't really know, but you want skin in the game and you want a dollar cost average. I think that's the biggest thing. And in all fairness, there's a lot of people out there that, I mean, you could do it at 30,000 here. And I think that's more than fine if you have that long-term horizon. I'm more of a shorter term trader, so I got to be a little bit more nimble at these levels.
Yeah, and I think risk reward, if it did drop down to 12, or, even if we had another major market crash and it dropped down to pandemic lows, which a lot of stocks have, your pandemic low was 4,500. So even if it dropped there, you have to reasonably expect it's going to get back to 30, at a very minimum. Will it get to 69? No guarantees, without the Fed, it definitely won't. But, there's no guarantees where it can go. And anybody who says, it can't go here or it won't go here, or can't, I mean, that's just silly. As we've seen, these assets will go, can and will go anywhere, up and down. Now, the other thing that I was talking about on that third level of confluence of 12,000 is initially last year, after those March, April peaks, and we were working our way down to the lows of, June, July in 2021, I was targeting 12K for potential downside back then, because for me, the way I look at it, that was the move where you started that back in June of 2019, before the pandemic. That was the beginning of the bull run until the pandemic got in the way. So to me, I think that's where the market was really starting the bull run was, right about, that next level there before the pandemic started. I think that's where it was already heading up for the new bull run of 2020, 2021. And, had we not had the pandemic, you wouldn't have had that little dip. So, the Fed has come out, and Neil Kashkari came out the other day and he said, he thinks he needs to see assets. Well, doesn't need to, but he thinks the Fed would not get involved, that assets need to basically go back to their pre-pandemic levels before the Fed even considers anything being, structural or abnormal. In other words, they will tolerate corrections all the way back to pre-pandemic levels in all assets before they will intervene or think about intervening. That's kind of what he said, verbatim yesterday.
Yeah. And that makes a lot of sense. In fact, that's been one of my kind of key points about where I ultimately think the S&P is going to go, is that if you look at it, I mean, we are hitting some support here, but if you look at this longer term trend, right? So this was the trend where it really goes all the way back to 2009, where the uptrend started in the market. And when we got into this kind of cycle of insane money printing because of the pandemic, the markets just took off. And look at the angle of that move versus the angle. And by the way, back here, and this, Greg, there was QE already. So it's not like there wasn't QE over here. It was just not the extent that was put into the market here. So in the very least, it makes a whole lot of sense that you would head back towards this area, which just so happens to be pretty much smack in the middle of that longer term trend area, right? So that's exactly kind of what I'm thinking too, is that the Fed ultimately, the Fed doesn't want to see this happen, because I do think that that they understand the effects of it. It could push us into recession if the stock market crashes enough. And question is, can they come support it if it does drop at a certain point? But I do think that's very likely to see that move back.
Yeah, yeah. And I mean, they do want it. He came flat out and said asset valuations are too high. They need to come down in order to, bring inflation back into check. So, I mean, yeah, they're doing this deliberately. They're bringing markets down back into correction territory to get them back on track, because this is what's causing inflation, the wealth effect. So, a lot of people are cashing out, throwing that money into the economy. So if they destroy some of that wealth, bring it back down to earth, then, that's going to taper, the inflation narrative, kind of like your tweet the other day saying they're letting the markets do it for them. So they're bringing the markets down purposely to let the markets, deal with inflation at a certain level. And, to your point, there was QE since 2009 when the program was instituted. But I think that last, 2020, infusion of $2 trillion was more than the entire span from 2009 to that point, I think, wasn't it?
Yeah, it was. And I think that's the bigger question is like, at least the one that kind of jumps at me is like, okay, well, the Fed wants to get asset prices back down. So let's say we do go back to the pre-COVID highs right here, which on the spiders is around 350 or give or take. At that point, does the Fed still have control, or are we spinning out of control into a recession that now they don't have the same tools because inflation maybe is still 5 or 6% at that point? And they can't print the same amount of money to get us out of that. And that's what I think the market is going to deal with. So you have this type of correction going on now, which is the market saying, oh, darn, interest rates are going up. We might see a slowing economy, but the market hasn't even started to broach that later, which I think that will later this year, which is, what if we go into a recession, and how does the Fed then get us out?
Exactly. And that's the thing. That's the corner that the Fed's painted in right now, is that, they're very clearly articulating and messaging our mandate is stable prices. So that's their number one talking point. It's an election cycle. So, there's no chance for, incumbents right now with inflation where it's at. So they have to get that somewhat under control. The only way to do it is to destroy demand and, basically put the country into a recession. The question is, if you're there, we're in a recession, but inflation is still out of control, and jobs. That's the other thing. So, full employment, stable prices is their mandate. The employment picture is lopsided as well, and they want to bring that back into check and, bring a more normal employment cycle in where, it's not so punitive from a labor, wage standpoint, so costly. When I say punitive to the economy, costly, which is creating inflationary pressure. So they've got a lot of work to do. And if markets tank and real estate prices reset, which they're doing, and that's just now starting, that's going to lag the markets by about 4 to 6 months, as it did in 08, 09. A few months it lagged, at least for sellers to adjust their, understanding of where prices are. The affordability index has already been cut in half on real estate just from interest rates. So there's a lot of things going on. And, the Fed's pinned. They've never been in this position ever in the history of the economy.
Yeah, that's honestly what scares me the most, is that, at a certain point, they run out of the ability to do anything. And then that's where you have this 100-year cycle. We talk about 100-year cycles of the pandemic with the Spanish flu. And then, you're coming up within the next less than 10 years to 2029, and you're talking about potential depression. And it's weird because you can almost see the writing on the wall, which is, okay, we slip into a recession. It gets worse and worse because the Fed can't print us out like they used to. And if they do, you see 20-30% inflation. And then what do? Just step back and let the economy crash and absolutely reset, which is kind of the worst case, but it is something we have to talk about.
It is. And, so let's clarify a couple of things. One, recession, that's just negative GDP for 2 consecutive quarters. That can be like 1%, which is a non-event. Depression is 10%, I think, isn't it? Technical definition, for the consecutive quarters, 10% reduction in GDP. So we're not talking about a Great Depression like people think of. When we say depression, we're just talking about, declining growth. So it's not like a doomsday type of situation like we were contemplating in the pandemic, when the whole world was looking at having to shut down when nobody knew what was going on. We're just talking about whatever that technical definition of a depression is. And I think it's like a 10% decline in GDP for, consecutive quarters or whatever. So even if that happens, that's not the end of the world. We are such a globally connected consumer driven economy right now, it takes a certain level just to keep the world going round that isn't going to stop no matter what the markets do, because the markets aren't the economy. The economy is the markets, so that's the thing. The valuations in the stock market has nothing to do with the economy. It's speculative. It's driven on these arbitrary values that are placed by investment firms based on, earnings and things like that. But at the end of the day, it's an arbitrary number that's placed on the value of these stocks that could be cut down by 75%. The economy still be totally fine.
Yeah, very true. Although I do think it's worth mentioning that you have a much higher, and I think I've seen stats on this, a much higher percentage of the US population is now invested than they ever have been before. Part of that happened, by the way, just in the last, since COVID, right? So many people, just, they were home, they didn't know what else to do. Oh, let's get into trading. Crypto is great. Stocks are great. GameStop, AMC. So I do think that it's more tied directly to the economy, meaning if you see a lot of people with 20, 30, 40% losses in their investment accounts, they're going to spend less money, which then slows the economy as well.
Yeah, exactly. So that's where you get to the depression level, technical levels of a depression, is that, if the wealth is destroyed that people have, then they don't have that excess money to spend. And, people have to re-enter the workforce, which balances out, what's going on right now. That's part of the wealth destruction. As markets come down, people go back to work. People that stepped out and said, hey, I got this fat portfolio to live on, they're having to go back to work now and things like that. But I mean, the economy can exist separate and apart from the markets. That's just my point, from stock
100%.
Valuations. That's not going to stop trade. If the market goes to zero, nobody's going to stop working. People are going to work more and work harder. So, that's my point. So what I'm saying is, from a valuation standpoint, markets can go much lower than where they are now without substantially affecting things, I've seen people calling for new all-time highs, and that's just without the Fed completely reversing course. You just aren't going to see that.
No, absolutely.
It's really interesting, but it's, fascinating times.
Yeah. And I just brought up the Qs chart because this was a level that I actually tweeted about a few days ago, this 300 level. You can see the beautiful kind of confluence of levels here, pivot, and then low pivot here. And you're getting this nice little bounce today on the Qs. Not a huge bounce, but we are up now over 2%, almost 2.5% on the QQQ. So I do think that that's worth keeping an eye on. It's just a short-term level for me, but I did pick up quite a few of these kind of beaten down tech names. And by the way, have you seen some of these tech names? They've just been absolutely demolished to points that even I am surprised at. The first 70%, I was like, okay, that was needed, and now it's like at 80, 85%. I'm like, okay, this is pretty crazy now.
It's .com. It's, 2001, same thing happened. And it was just because overinflated, overvalued stocks. And again, so to the point I was talking about earlier, Amazon. Okay. Amazon was one of the biggest, companies that took a biggest hit in the 2001 bubble. And, they're one of the strongest companies ever. So it didn't put them out of business. Their stock just devalued, and it took 15 years to come back. So you can be in a valley from a valuation standpoint of stocks and markets, and the economy can still be ticking along, just fine. And things are still rolling. But yeah, I took a trade on Lyft the other day when, Lyft bottomed out. And, I took a little 20% move there and got out, and I haven't done anything since, because I don't feel right yet. I still think there's too much, downside yet to come. We haven't seen capitulation yet. So that's the other thing, to talk about, is what capitulation looks like. We haven't seen it in the markets. Bitcoin came close yesterday just because of the Luna thing. And that was a Luna forced selling kind of an event there. It wasn't a true capitulation where investors, just naturally got scared and said, this is the end of this market cycle. It was driven by the Luna thing. But, if you go back to the pandemic, that was a capitulation event on Bitcoin where it dropped like 30, 40% a day.
Yes. It's wild, man. I'll tell you, one of the things I'm watching very closely, and I know you get these out very quickly, so it's worth discussing, is the CPI number tomorrow. I think the CPI number is going to be epically big for this market. The market wants to see peak inflation. If we get a slightly lower than 8% print on that CPI, the market will rejoice. If it's higher, watch out.
You'll get another. And it's so funny. Headline risk. The markets are so sensitive to everything, like we saw with the Fed, right? You had that huge bounce on a 50 basis point rate hike, and then the next day it just totally unwound. And continued down. So I think markets are going to finish maybe a little down, a little flat today, waiting for that CPI print tomorrow. And yeah, that's the trade. If it's up, it's down. If it's down, it's up.
Yep, that's right. And here's the 10-year yield chart, and you can see we broke out. But my guess is we're going to retrace and re-see this line before we make our next move up. But been a remarkable move in the 10-year, the 20-year, the 30-year. I mean, people with mortgages, like you're saying, I mean, it is just insane how quickly the bond market has done its thing and pushed yields up here. But again, it is starting to pull back. 10 years back below 3% now.
Yeah, that's interesting. It's the bond market's kind of funny, just not making a whole lot of sense. I would have expected it to, continue upward.
Yeah. The only thing I can think about is this, and again, I could be wrong, but is the bond market sensing there's two possibilities. One, the bond market it knows already that maybe the headline print tomorrow will be slightly lower. That'll make people relax a little bit about the inflation situation, which would be a reason why yields could come back in. Or the other one is that they're saying, hey, listen, the economy is going to slow dramatically later this year. Therefore, yields are going to come in because people are going to be buying less and inflation will get under control that way as well. So it's one or the other. Honestly, I don't know. It's one of those things where as economists, we just kind of look at it and we make our best guess.
Yeah, or it's just capital, rotation, so in and out of stocks and bonds, just kind of back and forth. Bonds were looking good. Now stocks are looking good. And, they're just kind of, moving the money in and out. But yeah, I think, I think at the end of the day, we have not seen the effects yet of, all of the inflationary drivers, the lockdowns in China, the war in Ukraine. I mean, a lot of those things haven't hit home yet, energy costs, things like that, the labor situation that we're in. We're still not feeling the true effects of inflation and, now the wealth destruction of what's going on and real estate market slowing. So there's a lot more left to play out before we get, to the end of this year with the inflation conversation. But nice bounces here and there. Like I said, that lift was a good one the other day. It was an all-time low. I got it, made a little 20% trade and got out of that. And I haven't nibbled since then. I've been kind of waiting, for, a bigger move. And I'm just not sure which direction the markets are going to take with CPI and everything that's going on right now.
Yeah, just for me, and again, it's important to mention I'm a much shorter term trader, but like, something like a Roku I'm nibbling on down here. You have lots of support. Yeah, isn't that incredible? But like, for instance, their earnings were actually they weren't horrible. The stock actually was up on earnings, but because of the market, they've been punished. So, taking a look at names like this, down like this. And by the way, look at that M pattern. And then it almost looks like a Bitcoin chart, right?
Yeah.
Except a lot further along in the scheme of things.
Well, on that note, so if you start looking at, where Bitcoin is now, I mean, that's kind of the direction it looks like it's heading, to that $12,000 mark. And then you look at the altcoins, I mean, some of those are going to go back, definitely are on their way back to, pre-2021 bull market run, back to single digits, sub dollar range, Avalanche, Solana, Cardano, Matic, all the big names are, completely unwinding.
Yep, absolutely. Absolutely. And I think it's important for people to recognize that, I mean, if we are witnessing a .com-ish type scenario, then where crypto's going is to demolish, 90+% of all the cryptos will essentially cease to exist, which is probably healthy for the system, right? I think the best of breed will survive and they'll thrive just like Amazon did back in .coms. And obviously it's gone way, way higher than its highs back then. But, I think there's like 19,000+ cryptos at this point. That there's no reason for it, no reason whatsoever. And it's not healthy for the system, frankly. It's kind of like too much cancer in the system, if you will, where you have to kind of get rid of it. You want the best to survive and thrive. Very Darwinian.
Yeah, and especially when you have like this Luna situation. I mean, that just, it makes zero sense to have this algorithmic stable coin that you're literally printing out of thin air to buy billions of dollars of Bitcoin. And then, all of a sudden, it's so vulnerable to liquidation like it is. I mean, the regulators are coming after it too. Janet Yellen was talking about it today. And, a stable coin that is not directly pegged to a dollar in reserves, where you issue a stable coin, you need that dollar in reserves held so that you can immediately liquidate. I just don't see that being allowed in the United States and most Western countries to be able to continue like that. Because even with Tether, so if you see what happened with Luna yesterday and UST, that's a small player. Tether is way bigger. And
Way
Tether is
bigger.
mostly backed by commercial paper. And you and I know commercial paper is not liquid dollar for dollar. Like a lot of
No.
people will say, oh, it's commercial paper, it's liquid. It's not. Those companies that, have issued that debt can't come up with that cash and pay it back. So if Tether had a run and had to start liquidating, it might be able to cover half. If it could cover half. My guess is it probably only be able to cover about 30%, but Tether can print. And, that's what they do. They just issue Tether just out of thin air. So, I mean, there's a lot of that's inflated these markets that's,
Yep.
hasn't come to light yet that ultimately could crack. And I mean, that's how fragile these markets are. Where you got to be careful in terms of what we're doing. And, to your point of things existing that shouldn't, that's the type of stuff that, at some point is going to be reined in and, could potentially have a big impact on the market.
Yeah, yeah, and that's kind of where I'm thinking whether if you're someone like me and we just talked about it earlier, where you have to at least see the S&P get back to that pre-COVID level. Well, that's still quite a ways away, right? I mean, you're still talking 10+% just to get to those levels. And if the Nasdaq continues down with that, the impact on the Nasdaq we know is great on cryptocurrency, which then spells even more downside in the cryptos potentially. Then you have to think that that's the angle of where this ultimately ends.
Yeah, yeah. And, and what I'm talking about is not unreasonable. Like, some people would think, oh, that's crazy. It can't do that, but it just did in 2017, 2018. I mean, markets dipped like 30%. So for the NASDAQ to get back to pre-pandemic, I mean, it's another, 10, 15%, maybe 20% down from here. It's already down 20%. So it's not that far of a stretch.
No.
Where things are headed. And without the Fed, and this is what I'm saying. So number one, that's an opportunity. So all of this, it's not negative, it's not bearish. These are opportunities for generational wealth creating moves like we saw in 08, 09, like we saw at the bottom March 2020. And, these are the types of moves that I wait for and look for. And,
yep.
I'm excited about those opportunities in Bitcoin. If it does crack that level of 29 and start heading down lower, I mean, it's just going to be an opportunity, that could be a generational event for a lot of people watching. So these aren't negative things. These are, number one, it's risk management. What's your upside potential versus your downside? What's your worst case scenario? I don't see Bitcoin like going away or being regulated out of existence. I think Bitcoin is here to stay. Some other things might go away and, disappear, but these are huge opportunities. I mean, knowing what I know now, I would have bought everything I could buy back in, March of 2020.
Yeah, I know. Don't we all, right?
Yeah.
But no, you're 100% right. I don't think Bitcoin's going away. I think especially, first of all, I think regulation is needed, and I think it will be good regulation. It's not to say that every rule is going to be perfect. We know the government by far is not perfect, but I do think that there's enough jobs that are built on the blockchain and cryptocurrency, and even Microsoft buying Activision Blizzard, where they're going to get into stuff, NFTs. I mean, there's enough jobs where the politicians won't regulate it out of existence. They want it to stay around. And that's ultimately going to be a good thing. And I think I've said this before, but you have to get Bitcoin and cryptos to the point where more people feel comfortable investing. So what does that mean? Well, one of the reasons why I don't put a lot of money in cryptos or in my crypto account individually is because if it gets stolen out because I clicked on a link I didn't mean to, well, guess what? It's gone for good, right? Versus FDIC insurance with stock accounts and banking accounts. So there has to be certain things done where a pension fund feels comfortable putting $1 billion in Bitcoin or crypto, where, mom and pop that are 85 years old, it's part of their allocation of their retirement. That type of thing has to happen. And we do need the government to come in and lay down some ground rules.
Yeah, absolutely. That's just going to lead to more broad scale adoption and, working these things out and, stuff like Luna. I mean, that kind of stuff just can't happen if you want a stable market with broad scale adoption where everybody's involved and, things are all on a, level playing field. Now, that being said, the stock market has its own level of, corruption and, just flat out manipulation, and things like that. And the big players, can do things that, you and me can't do, but, at least they can be held accountable if they get caught, versus this, It's just the wild, wild west. And, there's no stability really in these assets. And that's what these events like yesterday do. People look at that and people that bought in at 69 and they see where we're at now and see these types of things happening, once they get out, they're not coming back. A lot of people.
Yeah. No, you're 100% right. And in all fairness, you see this almost every cycle. Like if you look at the .coms, there were a lot of people that it took 5-10 years for them to reinvest in the stock market. And then unfortunately, what ends up happening is they reinvested in 2007 when it got like the market would never go down. And then we know 2008, 2009 happened. And then the same thing. I mean, for years after 2009, every year, 2010, 11, 12, 13, 14, it was always, where are all the small investors? They're not back in the market yet. Well, guess what? COVID brought them back in when the markets just continued to go up. When we only had 3% corrections for like a year, that was the biggest drawdown for over a year. It brought people in because they thought they couldn't lose, right? It's the easy money train. And then guess what happens? It's the top. And here we go again, and again, people have to start to, and this is hard to, people just won't realize this, but you have to shape your mind to buy the fear and sell the greed versus the opposite, which is what human emotion makes you do.
Yeah, exactly. And, to that point, I made a trade on AVAX yesterday and, that's up, I don't know, 20% right now. And,
yeah,
I mean, I didn't know what it was going to do yesterday and I had to look at it and say, well, what's my worst case scenario? And worst case scenario, it could have dropped back to single digits, where it was before it started in 2020.
And the best way to regulate emotion is by doing proper share size. And I'm sure you did, Greg, in terms of like, when you go into AVAX and you leverage 10 times, you're going to be, every tick, you're going to be freaking out. But when you do it with like the proper allocation, like 5% of your portfolio, well, then you know what? Yeah, you might make decent money if it does, but you're not going to freak out about it. So you really then can rely on the real thought process through it, not kind of fear and emotion.
I tell you, I was this close and going in UST when it got down to 60 cents. I was sitting there watching it and I was tempted to pull the trigger but I don't know. I mean, is that thing going to go away? Is it going to come back? I mean, I don't know.
Yeah, I think once you get, and I think in those situations, it becomes, just smart to be safe, right? Because if it does go away, you lose everything versus if you're wrong on an entry, maybe it drops another 10 or 20%. But if all of a sudden, let's say it gets halted and you can't even, you just don't know in those scenarios. So
yeah, that one was a little tricky for me. But AVAX, I know that's not going anywhere. Long term, that's a decent asset. It's got a lot of support where it's at right now. So I felt
look at the support on AVAX. I actually picked up some down here too. I mean, this is just such a good level for at least a near-term bounce. I mean, I actually picked up some Solana, same thing. I mean, I love multiple trend lines, pivot low. We went right there. Plus you had this extra support right here. Even Polkadot, take a look at Polkadot. I picked this up yesterday, but look at this little pivot low right here, hits it perfectly. Mm-hmm. And then look at that bounce, over 10% already just there on that bounce. So again, even if we are in a bear market, and I think you'd agree with this, is that there's still lots of opportunity. It's the more volatility there is, the more opportunity, as long as you know what you're doing.
Now, the difference is, buy the dip, sell the rip in a bear market. Don't look for that hodl play in a bear market because you don't know where the bottom is. You don't know how much more downside. Well, I'll tell you, I do know. And I'll tell you the ultimate buy signal. Here's the takeaway from the video. Do you know when bear market's over and it's bull market on again?
For me, it's when I see no one talking or even going near it. Like literally, and I still remember this in 2017, is CNBC used to have the Bitcoin ticker on the bottom of their screen. And in 2018, when it was basically down below 10,000, they took it away and no one talked about it. And that was the time to start accumulating.
So for me, we saw the signal in March 2020. It's when Neil Kashkari, the most dovish member of the Federal Reserve Board, comes on television and says, we have an unlimited cannon to support these markets. And that's what he did on 60 Minutes, back in the pandemic low. He came out. He is the spokesman for unlimited funding for the markets when the Fed wants to send the signal, bull market's on. So when you see Kashkari come back out,
monetary theory, huh?
Pivot, the Fed pivot. To me, that's the ultimate buy signal for bull market on. When you see Fed pivot.
And I do think that I've said this for a long time, and it warrants reiteration, is that there will be a pivot point where inflation comes down. I don't think back to 2%, but let's say it's 5%. And unemployment starts to spike due to a recession and goes to 7 or 8 or 9%. And there will be a point, even with 5% inflation, that the Fed turns the spigot on again and starts printing.
They're going to have to. I mean, companies are already laying off. So the housing market is changing. That's already starting to change. Automobile dealerships and manufacturers are laying off. Tech industry is laying off, startups, because the funding is not there for these startups, so we're already starting to see layoffs on a daily basis, but not big enough to make a dent. The the labor market's kind of like the housing market, right? So it's going to take a little bit of time for that demand, to ease up a little bit and that situation to change, but it will. And, the Fed's going to ultimately have to pivot at some point, unless, like to your point, they can't. And then the market just has to work itself out, which a lot of economists have been arguing for the Fed to back off, stay out of the markets, and let it do what it needs to do.
Yeah. And by the way, I'm a big fan of that thought process. If we were 30 years ago, problem is the Fed has had the markets on and the economy on life support and kept on resuscitating over and over again, that at this point, I mean, if they just stepped away, the downside would be cataclysmic, in my opinion. It would be, I mean, it would be healthy, but it would be so nasty. And I don't think they have the stomach for it. And I certainly don't think the politicians have the stomach for it.
Yeah, I think they pivot at 50%. I think they'll let the markets unwind about 50% from all-time highs, which is still another 20 to 30% from where we are now. I think that's when they step in.
That makes sense. I agree with you. I think that makes sense.
Yeah. So anyways, we'll just have to wait and see.
Yeah. Means our next conversation will be a blockbuster again. There'll be something big going on.
Cool. Well, Gareth, it was great catching up, and we'll keep an eye on this thing, and maybe if anything big happens, we'll do this again. But until then, I think we might have a little bit of hopefully some quiet consolidation going on here for a little bit to kind of see where things are going to land.
Yeah, sounds good to me. All right. Have a wonderful day, and thanks for having me.
All right. Talk to you soon.